Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is April 22nd of 2022, and it's been another volatile week. And certainly after a nice rally or the first, what was it, the last week of March and the first week of April, we've had this reset again, going back toward the lows of March of just over a month ago. And so when we're thinking of all of this, what we have to say is, first of all, when is this going to end? It's been painful. There's no doubt about that, especially for growth stocks, which is the area that our main flagship opportunity strategy focuses in on. But number two, are the companies underneath building value or destroying value, and what are those prices doing? I can tell you unabashedly right now that the companies that we own, so far we've had 3 companies report. All 3 have been absolutely fantastic reports, whether we're looking at Tesla or Snap after the bell. These have been absolutely Silvergate, great reports. So underneath the surface, value is building. Momentum is building. It's just getting past the extreme global pessimism that we see across the globe right now. And when that breaks, we should see a very nice repricing upward. And that's why we're calling this week's presentation, when will it end, right? And poor investor sentiment right now and the angst over rising prices, whether it's at the gas pump or at the grocery store, is really starting to mask what we think is very slowly a sea change in the market. So big 3 points from this week's presentation: investor sentiment is frozen dead, back down to 1991 levels, 2008 lows. This isn't 2008, ladies and gentlemen. We all went through 2008. Number 2, bonds are experiencing the worst start ever in human history. This has important implications as it relates to how we want to allocate assets in the back half of 2022, and what will lower inflation and interest rates ultimately mean when those come to pass for stocks, for bonds, and everything else. Welcome to the apocalypse. Record inflation, soaring cost of living. We got the largest land war since World War II taking place between Russia and Ukraine. Political turmoil across the Western world, big power competition between China, Russia, and the U.S. They challenge U.S. hegemony. And lastly, commodities continue to shoot higher. Now, all of these things have fed into this deep sense of pessimism. And when we look at investor sentiment right now, it is back down to levels of 2008 and 1991. And so I know it's hard to fathom this, but when it is this depressed, when it is this pessimistic out there, it really is a bullish buy zone. Does that mean stocks are going to bottom tomorrow? No, and we've been saying that for the last 2 months. We don't know when that exact week or day will be as it relates to a bottoming in stocks. But what we do know is that when things do turn, when things start to get less bad, and they already are starting to get less bad, we should see that rotation begin to take place. So what we did here with our data team here in San Diego was we said, okay, let's look at the 50 least bullish sentiment periods of time, and what were those forward rate of returns. And so what we see is over the next year, when we've had all instances of very bearish sentiment in the market, we've had a 17.65% rate of return over the next year. Now, remember what I'm saying here, over the next year, not the next week, not the next day, over the next year. Those 90-day forward returns are about 6.1%. Now, if we turn and we're only up 6%, that I would be shocked. But nevertheless, when we see this type of extreme pessimism, we have to ask that question: is this a buy or sell moment? And we know the performance over the last year hasn't been good with this particular growth strategy, the opportunity strategy. We get that. And we have a value strategy called the blue chip. And the conversations we're having with investors is we can certainly rotate you into our value strategy, which is actually flat year to date. I don't recommend it because we get paid the same fees regardless, but I got to look at what do I think is going to generate the best return for clients with a long-term track record and a high risk tolerance over the next year. And I think it's growth stocks, and we're going to go through why. Consumer sentiment is back down to 2008 levels when unemployment had skyrocketed, when the banks were collapsing, we were going through the Great Recession, the worst recession since the Great Depression. And yet consumer sentiment today, with record low unemployment, yes, inflation's high, but people have jobs, is back down to 2008 levels. And again, what do we see when consumer sentiment or consumer confidence is this low? Forward returns about 15.64%. So again, do we want to buy or sell at these levels? So what puts in the bottom? What puts an end to this? It's quite simple, ladies and gentlemen. We need that 10-year, that 30-year yield to start to peak out. We've got right now about 9 to 10 interest rate increases that have been priced into the market. We'll go through that in a second. But in the in the early to mid 90s, we had a very similar period where we had this big rise in interest rates and we had this stealth bear market. What was getting hit? Tech, biotech, healthcare. Guess what? The 90s were pretty good for technology. So my point here is that once yields started to top out, what did we see? We saw a massive recovery. Now, again, we can't guarantee anything, right? But history doesn't repeat itself, but it often does rhyme. And we do think we are still early in the business cycle, and we think the economy itself, outside of the inflation scare, is pretty healthy. We had that inflation scare in the 90s, the Fed killed it, and we are off to new highs. And so that's really the picture we see setting up here. And we know that the bond market's been awful. It's been the worst year ever in terms of peak to trough. We're having a 7 sigma moment in the bond market. And I want to stress that right now. The 360-day Z-score for 10-year interest rates is over 8 sigma, 8 standard deviations. That is absolutely incredible. When things get this extreme, that's typically when you do want to go the other way. And I've been in this career for a long time, and I've never actually seen an 8 sigma moment. So I think this is truly a historic moment in the bond market. And we have a lot of investors across the world that are in bonds that are not tolerant of risk, that are sitting on 7-8% losses. And that will change at some point. And so we think that this is a moment here where it's just a matter of time between when that rotation finally does ensue. So what's that easy trading model to follow? As the economy is accelerating, we get these positive sigma events. We want to shorten duration and buy value stocks. But when it starts to go the other way and we get these negative sigma events in the bond market like we're having today, and the economy is slowing and inflation starting to show signs of peaking, we want to lengthen duration, both in stocks and bonds, which is why you saw us buy the TLT in the preservation strategy. Why? Quite simply, because when you get negative 8 sigma events like this, which again, incredibly rare, is when you actually want to start to go the other way. So understanding expectations. Yes, the Fed has only raised interest rates 1 time. But what is actually priced into the bond market? 9 rate hikes. 9 rate hikes. That's a very important point. The Fed has already raised interest rates 9 times. When we look at the cost of money, when we look at the cost of lending products, whether we're talking about mortgages, auto loans, personal loans, those products, the cost of money has gone up 9 times already. The Fed is merely formalizing those moves through Federal Reserve policy. That's why we're saying right now we think these rate hikes are front-end loaded at the beginning of this year to the end of June, and we think inflation has already started to feel the impact of more expensive money. We see used car prices already coming down. We see signs of peak inflation. We look at freight rates. This is the dotted line here, already coming down dramatically. We see with freight rates in Shanghai, despite the shutdown, down 30%. All of these factors are starting to peak out. And then finally, with the yield curve, this was the peak in growth stocks when the yield curve started to flatten out. Now what we've seen is a reacceleration. So again, a lot of things are coming together. It's just a matter of getting the spark. And we also know the stocks are actually, the companies are doing pretty well. That's the most important thing long term. Remember that. Now, the factor matrix, remember this, accelerating growth with rising rates and inflation. That's where we shift from growth to value. That's what happened last year. We got a hot economy, 6-7% GDP. That is kryptonite for growth stocks. When growth starts to slow back down to a sustainable 2% level, we start to see that shift from value to growth. Anything below that, where we're experiencing a contraction, that's recession. That's when we want to raise cash and buy bonds. We don't see a recession on the horizon. So overall, in terms of that bottom line, investor sentiment has reached historically bearish levels, and now is the time to position for the next 12 months. We know the last 12 months have been awful, right? If you've been a growth investor, it's been awful. But what we have to do as investors look forward and say, what's the next 12 months look like? Most bearish since 1991, more than 2008. That is bullish. Core goods inflation appears to have peaked. Used car prices have peaked. Many electronic component prices have peaked. Freight rates have peaked. That will feed through into CPI and ultimately interest rates and inflation further down the road. That is positive. That's positive to position for duration. Duration means growth with stocks and means longer dated bonds in the bond market. Pure growth style factors should historically outperform and lead performance in this type of environment. Again, we know that the last few months have been rough. If you have any questions, please feel free to reach out to your advisor. But what we got to do now is look forward and understand what leads from this point going forward. And so if anyone has any questions, feel free to reach out to your advisor, reach out to us directly here at the home office, and have an absolutely fantastic weekend.